What's up, everyone? This is Tyler McBroom, and welcome to the Cash Flow and Grow Show, where we teach you the financial habits and routines and tax tips that you need to maximize your cash flow. All right, so today we're going to get into a Q&A show again. It's the end of the year. We are recording this in early December. It'll be out just shortly after that. And so naturally, there are a lot of tax questions coming up this time of year because we are in what we call tax planning season. It is the most wonderful time of year because it is a time of year where you can do all the things you need to do to save as much tax as possible. So looking forward to digging into a bunch of questions. Just if you do want to submit a question for yourself, you can either keep an eye out for me on Instagram. I do a lot of Q&A submissions over there at Tyler McBroom, or you can email your questions to tyler@tylermcbroom.com and we'll get them on the show. All right, so let's get into it. All right, so the first question is, can I start an accountable plan in December? So what an accountable plan is, it's essentially a written document that says that you have a policy in your company to reimburse personal expenses paid for outside of the business to yourself from the business or to other employees from the business. And so the setting up of the plan is a written document, and you can do that at any time of the year and still take advantage of it for the entire year. Now, how it works in terms of if you accidentally paid for a personal expense or a business expense, outside of your business, that expense is deductible not when you make the purchase, it's deductible when you cut that check or move that money from the business account to your personal account. So what you want to do is before the end of the year, or really anytime before you file your tax return, have that written accountable plan in place. And then before the end of the year, which is December 31st, the end of your tax year for most people. Sometimes businesses can have different calendar year ends, but or fiscal year ends. For the most part, it's December 31st. What you want to do is total up all of those expenses that were paid for off of a personal card that you don't pay off through the business or out of your personal checking account. Total those all up and then transfer that money from your business account to your personal account before the end of the year if you want to take that deduction this year. Now, we've talked about this before. If you're in a situation where your business is growing rapidly, this is where tax planning strategy and decision making comes in. Because if you're in a situation where your business is growing rapidly and you might be in a much higher tax bracket next year, well, if you wait to transfer those dollars from your business account to your personal account until January 1st, then you save that deduction for next year. But let's say it's $5,000 of expenses that you paid for out of your personal account that you need to reimburse yourself. If you're in a year where you're just getting started and you're in, say, a 15% tax bracket, but you are growing rapidly, so next year you're going to be in a 28% tax bracket, well, that's a 13% difference. So on a $5,000 deduction, that's a $650 difference in taxes. So if you can afford to wait for a whole year on the cash flow, you can increase your tax savings by kicking it to the following year. Now, the reality is though, most business owners I know, they'd rather take the deduction now and worry about next year when next year's problems come around. So that's up to you though. I just want to make sure that you're aware of that decision-making process as you go through that setting up the accountable plan. All right. This is another question. This is about single member S corporation and paying for health insurance for the owner. And so how does that work? So health insurance, number one, even if it's just for you and the owner, you can write off as an owner of the business health insurance premium expenses for yourself and all of your dependents, including your spouse. And so how that works is whether you pay for it out of the business or not, the total premiums that you pay for the year get added to your box 1 wages of your W-2. And what that means is box 1 is the amount that's subject to income tax. It's boxes 3 and 5 that are subject to Social Security and Medicare tax. So it doesn't get added to Social Security, to payroll taxes that you pay, but it does get added to your officer compensation total, which is a good thing because the single biggest risk of getting audited as an S corporation is not having the right amount of reasonable W-2 compensation for as an officer. So you add the total premiums paid to your Box 1 wages, and that becomes a deduction as officer compensation expense to the S corporation. But then you report those W-2 wages on your personal tax return, and then write off the total premiums as self-employed health insurance expense. So you don't write it off as insurance in the business. You don't just take a distribution and call it a non-deductible expense. That's how you do it. It gets added to Box 1 wages of your W-2. You pick that up as W-2 income and then write it off as self-employed health insurance expense. A lot of, if you want to make sure you double check, if you use a third-party payroll provider, then you want to make sure that those health insurance premiums get added to those Box 1 wages. A lot of payroll providers mess this one up. So make sure you're double checking with them and confirming with them before they process that last payroll at the end of the year. All right. So we got a question here. Can gift baskets, etc., be a write-off for clients? And the answer is yes, but it ain't much. So the gift expense deduction was written into tax law somewhere around about the 1960s. I forget the exact year. I think it was maybe 1964. And they said you can write off a gift expense up to, get ready for it, $25 per person per year. Wow, that's a lot of money. So then they know a lot of other tax deduction items, things like the standard deduction, child tax credit. A lot of those have been indexed for inflation over the years. This poor little gimpy gift tax deduction has stayed the same since the way long ago. But if you want to give someone a gift and write off more than $25, what you can do is give them some company swag. So if it's got your logo on it and you have maybe a gift basket, might be a hard one to slap a sticker on because it's got to be like a permanent logo thing to be a swag expense. But if instead of giving them a gift basket full of dried salami and fruits, you can give them a nice comfy company blanket, or a tumbler or a power bank or something along those lines that's got your company logo on it, then that's marketing expense, and you absolutely can write off all of that. So that would be the difference as being strategic about what type of gifts you're giving to your clients. It's absolutely a great thing to do, and always people love warm and fuzzies and receiving gifts, and it's a nice thing to do. All right, so next one, now that we're in December here, is it smart to buy a car in December and take the full depreciation on it for the year? For context, this particular person says they're a 1099 realtor and they will use the vehicle for business. So I say yes, as long as you actually need the car. So I think the biggest sort of faux pas that I see people do is they just go out and buy a bunch of stuff that they don't need before the end of the year because it's, quote, a write-off. And for most people, they're in somewhere between the 24% to 35% tax bracket, marginal tax bracket. And so let's say you're in that 35%. Well, if you go buy, say a really nice car, you go buy a $100,000 car, if you use it 100% for business and it's a large vehicle over 6,000 pounds, it's not an SUV, and you get to write off all of it, you still you save $35,000 in tax. And so you're going, and still 100,000 minus 35,000 is still 65,000. So I see it as, it's kind of like back in the days when people went to malls. It's kind of like going to the mall and you see a big for sale sign on the store and it says, everything's 35% off. Well, you still have to spend all that money to get that 35% off. So it still costs you money to spend. You're not saving money, you're just spending less. So make sure that if you do buy a car before the end of the year, that you actually need that. If you were going to need a new vehicle for the business or just want one for your personal life anyways. So that's just one thing about buying the cars, or really buying anything right before the end of the year. Because most people's idea of tax planning is go buy stuff. And there's way more you can do for tax planning than just go buy stuff. So setting that aside, is it smart to buy a car and write it off before the end of the year? So the answer is yes. I mean, it's a great time to buy. So if you buy it on December 20th, and you use it for at least 50% business use in the year you place it in service, then you get to write off 100% of the business use if it's an over 6,000 pound vehicle. Now, there are some laws changed a little bit that says that if it's over 6,000 pound SUV, you're capped at around $30,000 of deduction, no matter how much the car is. But if it's a big truck, then the sky's the limit. And so you can, if you buy let's just use that $100,000 vehicle, and the math scales up or down. But if you buy a $100,000 vehicle, save $35,000 in tax, and your payment on that is $2,500 a month. Well, now you just accelerated a year of cash flow. So that's a good thing to do if you need the car anyways. And if you buy it the difference between buying it in December 20th versus buying it January 5th is that deduction is taken a whole year earlier. So I'm a big fan of that. I think the one thing that you got to consider when you're looking at buying a vehicle is the method you use to track vehicle expenses, and that is there's two methods. So one is the mileage rate method, and then the other is actual expenses. So the mileage method is you document all of your business miles, so it's things where you're driving for business, whether that's driving to a client, driving to the store to pick up some office supplies, driving from one office location to another office location, which, by the way, can be your home office location to your office. Little side tangent there. Driving commuter miles from your home to your office is not deductible, but driving from office to office is a business mile, and it's for business purposes. So if you set up a qualified home office with that accountable plan that I mentioned earlier, now you're driving from office to office, and every commute from home is no longer a commute, it's just driving from one office to another. So that's just a little side note there to set things up to save you a couple grand this year. So you can track back to the mileage versus actual. So you total all your business miles. So let's say it's 10,000 miles in a year, and then you multiply that by a mileage rate. It's in the 60-ish cents. It changes every year, so I don't waste brain space in memorizing it. But it's around 61 or 62 cents in 2024. So if you had your 10,000 miles, you multiply it by 62 cents, let's say, and you'd get a $6,200 tax deduction, and that would save you roughly $2,500 in tax. To $1,500 to $2,500, depending on your tax bracket. That's the mileage method. The actual method is you total up all of your expenses that you spent on your car. That means the new tires, if you had new tires. That means oil changes, repairs, fuel, car insurance, all of that, and the purchase price, which is written off as depreciation. You total all that up, and then you multiply it by the business use percentage. So you track your business miles and your personal miles, and you divide the business miles into your total miles to figure out your business percentage. So if you've got, in this case, those 10,000 business miles, and you drove total 15,000 miles in a year, that's 2/3. So now your business use percentage is about 67%. You multiply that percent by all of your expenses, and that's your auto deduction for the year. It is almost always better to take the actual expense deduction, over the mileage deduction, because almost every car on the road, when you factor in depreciation and the true cost of ownership, is more than the 60-something cents per mile that they give you. The only reason you want to take mileage is if you just really hate keeping records like that, or maybe you only drive your car maybe 500 or 1,000 miles a year for business, so it's not worth keeping all of those records. that would be the reason to just take the mileage rate. But yeah, I'm a big fan. I mean, 2 years ago, I bought my truck. It was a used truck, but it was new to me, and I bought that on December 22nd and was able to take that write off in 2022. So if you need the car, big fan of it. And then kind of a follow-up, this is a different person, but a follow-up vehicle question is, does Section 179 depreciation apply to leased vehicles? And so what Section 179 is it's that rule that says if your vehicle is over 6,000 pounds or any large equipment, you can take 100% of the purchase price, of at least the business use percentage of the purchase price in year one, in the year of purchase. The exception being that SUV rule that I said where it's limited to $30,000 or $30,100, I believe, in 2024. So whether it applies to lease vehicles or not depends on the type of the lease. So in general, vehicle leases are written off as you pay them. So let's say you go down the lot, you go lease yourself a Toyota Camry, and you drive it off the lot, you start paying your monthly payments, and you use that vehicle for business. You write it off, you take the lease deduction as you make the lease payment. The exception to that is when the lease structure and terms qualify for something called a capital lease. And there's a few different criteria. Essentially, kind of at a high level, it's what's the total value of your payments relative to what the purchase price would have been if you purchased it, and then what's the value at the end of the lease, the value of the asset that you're purchasing. So there's a few different criteria that I won't get into on this episode, but just know that's a question to talk with your CPA about, is can I write this off as a capital lease? Because if it's a capital lease, then that's essentially treated for tax purposes and financial statement purposes as you bought the thing. And when you do that, then you can take Section 179, you can take bonus depreciation, all of the other accelerated depreciation benefits that you would get as if you purchased it, but sometimes it's easier to qualify for leases. Now, another kind of corollary question to that wasn't asked, but I'll just bring it up, is it better to buy or lease a vehicle? And that is, the answer is, in general, you want to look at what is the better financial deal. And almost always it's buying, because when you look at the actual contracts of a lease, usually what's called imputed interest rate is way higher than what a car loan would be if you go buy the car. And a lot of times what I hear from people is that they think that the lease is better because they can write off the payment each month. Well, when you buy it, you can do the same thing. It's just called depreciation expense and interest expense instead of lease expense. So it ends up being the same amount of write-off. It just is put in a different spot on the income statement. So in general, I like to almost always say buy the car for business over lease the car for business. Those are the questions we got for today. If you got some value out of this, we don't run ads or anything on this show, so would love it if you'd go share this out with a few business owners that you know could benefit from this. And we'll see you on the show, or see you next time. And go ahead, if you've got questions, submit them either Instagram or through Tyler at tylermcbroom.com. We'll see you next time.